Deal of the morning, Cisco striking a deal to buy cybersecurity company Splunk. $157 a share in cash as part of its push into AI. That is the focus of today's Tech Check with Deirdre Bosa. What do you think, Dee?
Several different angles baked into this deal. There's what it says about Cisco and legacy tech, what it says about enterprise software valuations, and of course implications for the M&A market. Let's take Cisco first. At $28 billion, Splunk is its biggest acquisition, and it signals where the company wants to go. At its core, Cisco is still a legacy tech hardware company that's trying to pivot to software and services. Bringing Splunk into the fold, that will not only help with top-line growth, but it gives Cisco more heft in cybersecurity and artificial intelligence, two of the buzziest subsectors in tech right now. We've seen other legacy tech use the same playbook, like IBM and Red Hat. Whether it works, though, that is still very much an open question. The deal could suggest that enterprise software has bottomed. Splunk is a stock that touched nearly $200 in 2020 and corrected aggressively with the rest of the space at the end of 21, falling to about $75 a share. The $157 Cisco was willing to pay, that could really get other SaaS companies to perk up and think, hey, maybe we could get closer to those peak valuations too. Or, and this brings me to the third implication of the deal, they could be encouraged to do deals of their own. Between a new wave of IPOs and this deal, capital markets, they are signaling that they are open for business. One analyst this morning writes that Cisco's Splunk, quote, speaks to a massive wave of M&A on the horizon over the next 6 to 9 months. And big tech has shown that they are not sitting back and letting a new generation of tech companies lead this AI platform shift. They are going to partner, acquire, or develop their way to the lead and push regulators or find creative ways, a la Microsoft OpenAI, to do so. The last point that I want to make is that this deal could also be a sign that investors are starting to look for growth again, and that this drive for profitability we've seen over the last few years is bearing fruit. Splunk, it's still unprofitable on a GAAP basis, but it has narrowed losses, especially after it came under activist scrutiny last year. And likewise, Klaviyo came to market yesterday with narrowing losses. It was well received, pricing above its IPO range and trading higher on its debut. Guys, we zoom out even further, look at the whole enterprise software space through the IGV ETF, excuse me. It is up nearly 35% this year, outperforming the broader NASDAQ. Guys?
That's what was so curious about the deal, Dee, is that is management had a little bit of momentum. Stocks obviously had momentum. Last couple of quarters have been solid. The question to Steele on this desk this morning was, why now?
Exactly. And it speaks to the sort of idea of valuation disparity we've been talking about over the last few years. The enterprise tech space is trying to figure that out. A 30% premium that brings you back to $157 a share. I mean, Splunk hasn't seen that since 2021, arguably the peak for enterprise software, though not its peak. So that's why it sort of has these important implications. There could be CEOs in public and private markets thinking, where does our valuation land? Are markets coming back up? Is there appetite once again for not just enterprise tech companies, but still unprofitable ones that are narrowing losses? So the timing is really, really interesting for a lot of enterprise tech companies. It could be a question between private equity and strategic acquisition, right? There are few big PE firms that are able to do a deal the size of a Splunk, but there could be strategic M&A, and this really brings legacy tech into the picture. Those companies are looking to reaccelerate top-line growth.